Imagine this, it's 1995, an investor stands at a fork in the road. One path leads to a cozy rental property in a growing suburb, promising steady rent checks and a tangible asset. The other, a wild ride on the stock market roller coaster, where fortunes flick faster than a bad bet on a casino. Which do they pick? After studying cases over 30 years, I learned that smart ones grab both. Welcome to this Luis Tamborrell Investment Podcast, where we unpack real talk on growing wealth without the hype. I am Luis, and today we're gonna kicking off a 3-part series on comparing real estate and stocks. Because in my experience, ignoring one is like driving with one hand behind your back. Let me share a case I studied from the late 90s. An investor scrapped together a down payment for a small duplex in a growing suburb. No daily tickers, no CNBC panic, just tenants paying rent like clockwork. That property is appreciated 6% a year on the average, plus the cash flow covered the mortgage and then some. Fast forward 25 years and it has tripled its value. Real estate feels stable, right? Prices don't swing widely every second. Studies show residential real estate has averaged 4 to 8% annual returns historically. With commercial hitting around 10.3 over the last 25 years, why? Due diligence matters, pick right, and time does the heavy lifting. But here's the catch, valuations lag. You might not know your gain until you sell. Unlike stock, screaming updates every tick. But stability can be a double-edged sword. Enter the stock market fast, furious, and full of opportunity, or hardware. Consider cases from 2008. The market crashes 50% in months. I study investors who bail on stocks, swearing off them forever. Others, they double down on blue chips. During the dip, why? Over the long haul, the S&P stocks provides 10% annual returns, outpacing most real estate plays. From 1995 to 2025, it surged over 1,000%. But volatility? Brutal. Stocks can drop 20% in a week on a political news or earnings whispers, while real estate barely blinks. Its standard deviation is half of the equities. With more than 50,000 stocks choices, overwhelmed, but research tools make it easier than hunting property. Here is what 30 years of case studies have taught me. Both deliver similar results, around 8 to 10% compounded. If you are patient, real estate, slower burn, tangible security, stocks, quick ups, gut-wrenching downs. The real difference, risk-reward balance. Stocks amplify gains and losses via multiple on earnings. Think 20 times PE ratios versus real estate grounded valuations. But why choose? In our next episode, we'll map how to blend them for diversification magic. Hit subscribe, share it with a friend sweating their 401k, and drop a comment. Real estate or stock first. Remember, I'm not an advisor, just a guy sharing internet-backed insight from decades in the trenches. See you next time.